Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be talking about the second part of our vertical spread series on how to maximize income using credit vertical spreads. Now, a couple of weeks ago, we did our webinar on debit spreads, which is a very different strategy on basically taking advantage of a large directional move in one direction, either bullish and bearish, with a fairly limited amount of risk. Now, credit spreads, on the opposite hand, are more so for when you have more of a loose directional view, where you don't have a strong directional view. You don't necessarily think the stock is going to move a whole lot. Maybe you think a stock is about to defend a support level or a resistance level, and you think that it's not going to move beyond those levels, but you don't necessarily expect a big move. That's when you want to use credit spreads. Now, these are very different strategies. However, credit spreads are a very versatile strategy, and I think that's why many investors flock to them. I know a lot of you like to sell these credit spreads. They are useful in many different market outlooks and conditions. So today, what I want to do is I want to break down the strategy because it is a more advanced strategy than buying a debit spread. Selling a credit spread involves a few more things. It puts you at higher exposure of early assignment on an option. So it is a different beast as far as trading and managing this trade. So what I want to do today is I want to break down what a credit spread is. So for those of you that are brand new and not familiar with these strategies, to better understand how credit spreads work, why they're so forgiving, but also on the same token, what are the downsides or drawdowns and risks that you have with this type of strategy. Now, the strategy itself is really suitable for any of you that are selling naked puts, cash secured puts, or even cover calls and naked calls. I want to walk you guys through the strategy. I want to walk you through when you should deploy it and show you what our back testing and statistics show with respect to the optimal expirations and strike prices. So just like all of our webinars, what I'm going to do is I'm going to go through the slides here today, go through some examples, make sure that everyone understands the strategy and best practices before we jump over to Options Play and to show you some real-time examples, because I always think the best way to learn is by example. So before I go ahead and do that, I just want to do a quick poll here with the users here in the room. How many of you have traded vertical spreads before? And this is a multiple choice question, meaning you can select multiple ones. Either you've traded credit spreads, debit spreads, or you've only traded other option strategies. And for those of you that are just learning, welcome. This is meant to be an educational webinar so that everyone learns how to trade these strategies, even if you already have traded them. And then for those of you that are not sure, maybe you're brand new and you're not sure what all of these terms mean, just this gives us a sense for who's in the room. Okay, so about 2/3 of you have voted, and it looks like as far as vertical spreads, credit spreads seems to be outpacing debit spreads by almost 2-to-1. And about 2/3 of you either have only traded other option strategies or you're just in the process of learning how to trade options. So great, looks like we have a very diverse group of users here. About 1/5 of you currently trade vertical spreads, 1/10 of you trade debit spreads, and the other 66% roughly make up either only trading other strategies or learning how to trade. So actually learning how to trade is the largest group. So for those of you that are brand new, welcome. This webinar is designed again to help educate you on the strategies and what's available to you as far as options. And more importantly, what we want to do is we want to show you the technology that's available to you free of charge, courtesy of the Montreal Exchange, that allows you to analyze and explore these types of strategies before you go and execute them in your broker. Now, so today, here are the things that I want to go over. Before I do that, just a quick disclaimer. What I'm going to be talking about here today is purely for educational purposes. The examples that I will be giving is not a solicitation or offer to buy any specific securities. They're meant for information purposes only. And again, for those of you that already have access to Options Play, welcome back. And for those of you that do not have access to Options Play, you can sign up through the link that I just put into the chat window. Again, as a Canadian resident, one of the biggest benefits is that you get free access to options play with Canadian securities. You get access to bi-weekly options education webinars, just like the ones that you are on here. Free on-demand options video library so that you can view all of our previously recorded webinars, as well as weekly cover call and short put reports. Very useful for those of you that are selling these types of options for income. So especially if you're currently selling covered calls or cash secured puts, this is really the next step in your options trading, is selling credit spreads, because credit spreads is really just selling covered calls and cash secured puts and making them a little bit more advanced, and does not require you to either own the stock or want to own the stock like you do with a covered call or cash secured put. Credit spreads allow you to effectively have the same income stream as selling a covered call or cash secured put, without having to put up all the capital to own the stock. So this is really, for those of you that use those cover call reports and short put reports, very useful strategy for you guys to learn more about. Now, today what we're gonna do is we're gonna go over what are credit spreads. More importantly, when should you use credit spreads? I actually think that's actually a really important topic, because I see a lot of people sell credit spreads when it's not necessarily ideal to sell credit spreads. And what I'll do today during the example period is actually show you the credit spread next to some other strategies to show you when the credit spread actually underperforms and when you should not use them. I think that's actually a really important thing. Then we'll go over what are the optimized expirations and strike prices for credit spreads before we move on to how to actually manage these trades once you're in them. So with that, what I'll do is I'll go over what are credit spreads. Now, before I do that, I want to actually answer a very important question that's been brought up to me from some users. And that is, does your online broker support multi-leg options orders? Because all of the strategies that we're going to talk about here today are multi-leg options orders. So it's been brought up to me that some brokers do not support them, or some people are not aware of how to enter multi-leg orders. So I just want to get a sense for how many of you are aware what your broker offers. Okay, so this is a pretty interesting result here. So about a third of you say that your broker offers multi-leg orders online, which is great. For those third of you that are trading at a broker that facilitates that, 15% of you say, no, my broker only allows multi-leg orders by phone, which is another way to enter the order, but at least you have some way of entering the order. And almost half of you say you're not sure. So that is something that I want to address, and I will address this at the end. But if you're not sure, call up your broker, ask them, and you should definitely. If you're interested in trading all of these strategies that we went over, that we're going to go over today, and the strategies we went over a couple of weeks ago using debit spreads, you need to have a broker that allows you to enter these orders, preferably electronically, but at the very least, at least by phone. So if you don't know, call up your broker and ask. And I will say that, brokers will add functionality to their website based on client demand, no matter how much we and the exchanges tell the brokerage firms that they need to add this type of functionality to attract options volume. They may not do it unless their clients actually ask for it. So it's really important to ask your broker what they offer, so that you can help influence kind of your broker's decision, because those are some of the questions that we come across when we talk to some of the online brokers in Canada. So I just want to get that out of the way. So, and especially since almost half of you say that you're not sure what your broker offers. And it's important that if your broker doesn't offer multi-leg trading, then you wouldn't be able to execute the strategies that we're talking about here today, and the ones that we spoke about last week. So, and if anyone on the current webinar has a broker that offers multi-leg options trading, please type them into the chat window. I'm happy to share with everyone what brokers currently offer the ability to execute these trades electronically, and that'll help the whole group. So Shane is saying interactive brokers from Canada. I think iTrade is phone only. Disnat seems to offer multi-leg trading, TD Waterhouse. So again, if you have a brokerage firm that offers multi-leg options trading in Canada, please type them into the chat window. We can share that with everyone. So Quest Trade, BMO, Investor Line, Interactive Brokers, those seem to be the brokers that offer multi-leg trading in the Canada. Yep, so it looks like those are the ones that everyone is saying. Thank you so much for everyone that's responded to that. Let's go ahead and get started with our actual topic of the day, which is credit spreads. So first of all, with any vertical spread, it's important to understand that it doesn't matter whether you're trading a debit or a credit spread, they are both limited risk and reward strategies. Now, what highlights credit spreads from others is the fact that they have a relatively higher probability of profit. Now, this is what generally attracts most users to this type of strategy. And I think that's why when I asked the first poll, how many of you trade credit spreads, they seem to outpace debit spreads 2-to-1. Now, this strategy is a strategy that is net short theta, so time decay is working in your favor, and you're also short vega, so volatility is working against you unless volatility contracts, or you would want volatility either be stable or contracts in order for this strategy to work in your favor. And there are two credit spreads that you can trade. There's a bullish and neutral spread, which is a bull put spread, and there's a bearish and neutral trade, which is a bear call spread. And what we're going to do is we're going to spend the next few minutes breaking down these two trades so that you actually understand these two strategies and how they're constructed and why you should utilize them. But that's, in essence, what credit spreads are. So in order to really understand them, I want to go through the example of stock XYZ that's currently trading at $100. And let's say in this particular case, I have a bullish view on XYZ. And I think the best way to think about when this might be happening is actually think about a stock that's maybe trading from above 100. Maybe it starts to approach that $100 support level, and you think it's going to bounce a little higher, maybe bounce back down, but you think for the most part it's going to stay above that 100 level. What you don't believe it's going to happen is that it's going to cross below that 100 level. So as long as you think it's going to stay above, doesn't matter whether you think it's going to move a little bit or a lot above, as long as you believe that it's going to stay around 100 or higher, that is what we call a bullish to neutral view on stock XYZ. So if you believe that this is the case that you are in, one strategy that you can deploy is a credit spread. And to understand a credit spread, what we're going to do is we're going to break it down into its two main components. Number one, what we're going to do is we're going to sell a 100 strike put at $4. So when you sell a put, you're effectively saying that I don't believe it's going to go below 100, and I'm going to collect some income from selling that put. However, when you sell a put, you have truly unlimited downside risk. So if the stock goes all the way to zero, you're basically risking $96 a share because you've sold something for $100. If it goes all the way down to zero, you lose $100, but you collected $4 income. So your max risk on this trade is $96, and your max reward is just $4. Now, very few people like to take on that type of risk of risking 96 bucks to try to make $4. So, and you have the obligation of buying the stock. If the stock goes below 100 at expiration, you now own that stock. A lot of people don't want to have that obligation, or at least the risk of owning a stock that they don't want to own. So what can you do? A credit spread is a convenient way to allow you to still speculate on the stock staying above $100, selling that 100 strike put, but not take on all that risk and eventually owning that stock. So what you can do is you can buy a lower put against it. So now what I'm going to do is I'm going to buy a 90 strike put. And what that does is it caps my risk. That's the primary reason why you want to buy that lower put, because that spending a little bit of money will allow you to cap your risk. And now, instead of receiving $4 for that credit, now you're going to receive a net credit of $3. But instead of risking $96 a share, you're now risking only $7 a share. Now, the reason how we calculate the $7 is the difference between the 100 strike put and the $90 put is $10 minus the $3 that we're receiving in terms of credit. That's how we get the $7. So $10 difference or width of the spread, you collect $3 of that width, so the remaining is $7 or your total risk. So that's how you always determine the risk and reward of a spread, is the distance between the two strikes. Whatever your max reward is, the rest of it is going to be your max profit. Now, this strategy is the reason that this strategy is considered very flexible or very forgiving is the fact that despite the fact that I expect that this stock is going to defend that 100 strike level, I'm actually able to take profit. I'm actually able to profit on this trade, even if the stock goes a little bit below that 100 strike, because I've collected $3 income. My break even on this stock is actually just $97. So even though I think the stock's going to stay above 100, but if I'm wrong on that and the stock goes down to $98, I still actually make money on this trade. There's not a lot of option strategies that provide me with that type of flexibility. And in the case of the stock really drops, I'm limited in terms of how much risk that I can take. So if the stock drops all the way down to $50 because of some bad earnings or some event that happens out of the blue, that I'm limited in terms of the amount of risk that I take. And that's the benefit of a credit spread. But that is the anatomy of a bull put spread or a bullish credit spread that you can sell. Conversely, on the flip side, on the bearish side, you can also do the exact same thing. So imagine now I have a bearish to neutral view on stock XYZ. And I think the best way to picture this is if the stock is approaching its resistance level, let's say it's reaching from 90 up to 100, and you feel that it's not really going to breach that level. You think it's going to come down a little, move a little bit higher, and stay relatively neutral, but stay below that 100 level. Doesn't matter whether you think it's going to go down by a couple of bucks or 10 bucks or $5, whatever it is, as long as you believe that it's not going to go above 100. That would be a time to consider using a credit spread. So in order to trade that, you can do a few different things, but the first thing you would do is you would sell a 100 strike call. So let's say that you can sell an at the money call for $4. Now, the reason that it doesn't make sense many times to sell a naked call is because selling a naked call requires unlimited risk to the downside. So if the stock keeps going higher and higher and higher, then you're risking more and more money. So the way to defend that is to buy a 100 strike call. And let's say you spend $1 to do that, or 110 call rather. Let's say you spend $1 to do that. So now what you have is the same risk profile, but now the net credit you receive is $3, but you've capped your max risk from unlimited to just $7. And again, that max risk is calculated from the fact that the distance between the two strikes, the 100 and 110 strike, is $10 minus the $3 credit that you receive. That gives you the remaining $7 of risk that you have with this strategy. And again, just like the put credit spread, this strategy is fairly resilient and fairly forgiving because this strategy profits as long as stock XYZ closes below 103 at expiration. So you could actually get this resistance level slightly wrong, and the stock can rally a little bit above that resistance level to 102, 103, and actually still not lose money on this trade. So if the stock does poke a little bit above that resistance level to 101, 102, you actually still make money on this trade. Only if the stock rockets really high do you start losing money, and you're still capped at $7 of risk. So no matter what happens, even if the stock goes to 1,000 on some really good news, you still have limited risk. Unlike if you sold a naked call, you truly have unlimited risk. And that's the benefit of this strategy. It really allows you to take that income-based approach to generating income, but at the same time have limited risk, unlike selling that cash secured put. So with that, just to talk, now that we've talked through kind of the breakdown of the strategy, I want to talk a little bit about when you should use this. And it's really important to understand this slide because I would argue this is probably the most important slide out of all the ones that I'm going to go over here today. So we've talked about the strategy being a relatively forgiving directional strategy for neutral or mild moves. So especially when you're approaching kind of a support or resistance level, when it's near overbought and oversold conditions, those are great times to consider entering a credit spread. But it's only useful when you expect this neutral to small directional move. What I mean by that is that when you approach some kind of overbought and oversold conditions, especially if you're using technical indicators to determine that, those are great times to consider selling credit spreads. Same thing for reversals. So if you have a double top or bottom, if you're approaching a major support or resistance level, these are all opportunities to potentially sell a credit spread. The only time it doesn't make sense to use this strategy is when you're expecting a large and fast move. So if you're expecting a large and fast move, you do not want to use this strategy. And I think the best way for me to show you that is by going through some real examples, putting the credit spread next to a couple of other strategies to show you when the stock does make a big move, why there's why there are many other strategies that are way better for your trading than selling a credit spread. So with that, I just want to talk a little bit about, because I just gave you two examples, selling a put credit spread when it's bullish, selling a call credit spread when it's bearish, just to understand that those two strategies are not exactly identical by just flipping the strategy from bullish to bearish, because based on our research, there is a slight edge for puts versus calls, meaning puts have a slight edge over call credit spreads. And the reason for this is because when you're selling a put credit spread, what you're effectively doing is you are looking at a stock that may be sold off recently and you're expecting it to bounce higher. Now, the thing about that is that when the stock is declining, what's happening is that volatility is typically increasing in nature. Now, because this strategy is a short volatility strategy, what you're doing is you're selling that put when volatility is relatively elevated. So the implied volatility is elevated near that bottom right here. And when you get that bounce higher, volatility typically will contract. So what's happening is not only does the delta and the theta work in your favor, volatility, the vega component of your strategy is also working in your favor. Conversely, on a call credit spread, what you're doing is you're approaching a resistance level. So you're going from a stock that's currently low and rallying higher. Now, the problem with that is that as stocks rally, that usually depresses volatility. So by the time you're selling that call credit spread, the implied volatility is fairly low. So when you're selling it up here, volatility is fairly low. And if you are expecting the stock to drop, that's when volatility expands or gets larger. So you have this volatility aspect of the trade that's actually working against you. So this is really why when you're selling these types of credit spreads, both on a probability perspective, since markets tend to move higher than lower just from a pure probability and statistics perspective, but keep in mind that when you are betting on the market moving lower, you also have volatility working against you in this particular factor. So keep that in mind, that when you're thinking about selling credit spreads, for those of you that do this strategy, puts provide a slight edge than selling call credit spreads. So keep that in mind next time you're thinking about this type of strategy. So with that, what I have here is just a quick graph of a chart of a stock. And what I wanted, the reason I pulled up this chart was to give you a sense for, last week we talked about debit spreads. This week we're talking about credit spreads. I just want to show you how different these two strategies are, because I still get a lot of questions from users saying, how do I compare a debit spread versus credit spread? And I always tell users that you really shouldn't be comparing the two, because the two are used for completely different types of trading. So a debit spread is really for when you're expecting a large move. So here's an example of a stock that was about to make a big breakout after forming this major triangle for months. And then once it formed that triangle and started to break to the upside, that was the opportunity of at least a move back to some major resistance levels here, maybe this level and this level. So you had these pretty big targets to the upside. This was an example of a potential trade for a debit spread. As you can see, not only did it hit the first target, the second target, it actually had a bit of a runaway even beyond that. So that's an example of when you want to use a debit spread, because a debit spread is actually able to capture all of these profits as the stock keeps moving higher and higher and higher. And you can continue to roll your positions to try to keep capturing more and more, and do it in a way with relatively low amount of risk. Versus a credit spread is useful for when you expect the stock is near a support level and you don't think it's going to move very much beyond that support level, and there's not a lot of room to the upside. So even if this stock bounces off that support level, there's a fairly minor amount of move that it can happen. And when it reaches that resistance level, it's a fairly minor move that you might expect that stock to move. As you can see, half the time it doesn't even reach that resistance level. It goes about halfway. So this is really when it's more ideal to sell credit spreads. So as you can see, if you were selling credit spreads, you might do it over and over again on the same symbol, versus on a debit spread, there's not many opportunities to buy a debit spread on a stock. So the only other time I'm thinking is that right here, it seems to peak above that resistance level, and maybe this ended up being a bad trade or a trade that didn't work out. But that was potentially one opportunity to say, okay, I think the stock is breaking above that resistance level and it's going to continue moving higher. That might have been one opportunity to buy a debit spread. But all other cases, you would have sold credit spreads instead. So when it's near the top, you sell that call credit spread. When it's near the bottom, you sell that put credit spread. So just to give you a visual representation of these two strategies and why you really shouldn't be comparing a debit to credit spreads, because they're virtually used for completely different outlooks or market conditions that you have on the trades. So when you're selling credit spreads, there are a lot of different credit spreads that you can sell. Now, I know only about 25% of you say that you currently sell credit spreads. So for those 75% of you that don't currently do this, just bear with me for 1 second. But when you sell credit spreads, you can sell credit spreads across a range of strike prices. And if any of you have ever looked at an option chain, you're familiar with a page that looks like this. There are hundreds and many times thousands of expirations and strike prices that you can choose from, of which you have to figure out what strike prices you want to sell. So one of the things that you want to think about is when you can sell a credit spread that's relatively near the current price of the stock or near the money, or you can sell a far out of the money credit spread. Now, the reason I'm bringing this up is because I see a lot of users that like to sell really far out of the money credit spreads because of this. It tends to have high number of winners because everyone wants to have high probability or high number of wins. However, I want to make it abundantly clear that the risks of doing that is extremely, extremely high. When you sell stuff with 80, 90% probability of profit, what you're doing is you're really skewing the risk against you. Many times I see trades where for every $100 in income you receive, people are risking upwards of $900, $1,000, $2,000, even $5,000 in risk for just $100 in reward. And great, you might win 95% of the time, but that 5% of the time that the market goes against you and there's that big adverse move like we had in December 2018, you can wipe out months, if not years of income from just a single trade. So be very, very careful. Don't just focus on high probability of profit, because on paper that sounds really good, but in the long run for the health of your financial portfolio, generally speaking, that does not work out in the long run. Versus if you sold credit spreads that are near the money, you might only have 60 to 70% winners, but for every $100 in income that you receive, you're typically only risking about $200. Now that's much easier to swallow when you have those types of trades where you might win on 3 trades of collecting $100 and the 4th trade you lose $200 on. You're still in the black. Versus you can win, 5, 6, 7, 8 times on $100 income and then lose it all on the next trade. That's not the type of trading that you necessarily want to get yourself into, even though you have a high probability of winners. So be very careful that whenever you're trading these types of strategies, understand the trade-off between probability and risk to reward, because when you have high probability, that means you have really poor risk to reward. And to understand that relationship is absolutely critical to selling credit spreads or any type of option strategies entirely. So what we did is we researched these different option strikes that you can sell on credit spreads. We tried out every single possible combination of strike prices over the last 10 years or so, and tried to get a sense for which delta calls and puts make sense when you're selling a credit spread. And when we did this research, the numbers became very clear that number one, you want to sell relatively short dated options because you are short time decay or short theta, which is working in your favor. And you want to accelerate that by selling relatively short dated options. When it comes to strike prices, our data also shows very clearly that you want to sell an at-the-money call or put. So just like the $100 strike or the $100 support level that I was trying to defend in my examples, I want to sell the 100 strike put against that. And then what I want to do is I want to buy a 25 delta call or put against that to offset my risk. Again, we're buying that lower call or put because we don't want to cap our risk on the overall strategy. Now, when you follow these two strikes, what you're going to find is that the credit that you receive is going to be roughly 1/3 of the distance between the two strikes. So we talked about in the 190 put credit spread, that's a $10 wide spread. If I'm selling any options, a credit spread that's $10 wide, I want to collect roughly $3.33 in income, which means that I have $6.67 of risk on that particular trade. So for every $100 of income that I'm collecting, I'm going to be risking roughly $200. We tend to find that when you're risking more than 2 times the income that you receive, that's when in the long run, you're going to likely lose money on this specific strategy. So you might make a lot of money in the short run, but you're going to lose money in the long run. So when you follow this, you're going to see about 60 to 70% winners. About 33% of your trades will be losers, but on those losers, you're not going to wipe out all of the gains that you have in the previous 6, 7, 8, 9 trades in a row that you might have. It might sound really good to win that many times, but if the single trade that you lose wipes out all of it, it's not good at all for you in the long run. So what we have here is a table just to give you a quick reminder of different widths that you might sell, and roughly how much credit you want to receive based on the width of the credit spread that you're selling. So that's our research as far as what are the optimal credit spreads to sell when you're utilizing the strategy. So just to talk about a few different more things before we jump over to options play and show you some real examples. Number one, we've talked about managing these credit spreads. So first of all, to get into these trades, you want to time your entries with expected tops and bottoms. So it doesn't matter whether you're talking about a support level or a resistance level that the stock is approaching. When the stock is approaching a support level near that bottom, that's when you want to sell that put credit spread right around here. And when the stock rises back up to that resistance level, that's when you want to think about selling that call credit spread up here. And those are the times that you want to think about entering these types of credit spreads. Now, once you've entered them, the goal of this strategy really is to allow these trades to expire worthless. So just like when you're selling a cover call or credits or a cash secured put, just like those strategies, you want these trades to expire worthless and for you to keep the income that you sold. However, there are a few different scenarios where you do want to close out these trades prior to expiration. So number one, if in the case of the stock bouncing off that support level, what we typically find that is when you do get a quick bounce higher, when the stock, if you enter this trade near that support level and the stock immediately bounces higher, you're typically going to be able to take profits early. So if you make 50% of the gains of the credit spread with more than half the time left to expiration, that's a good time to take profit because again, this strategy risks more than the income that you receive. So if you get a small bounce, there's always the possibility that this stock drops. And if that happens, what you're doing is you're risking more than the income that you receive. So when you can collect 50% of the gains and you still have more than half the time left, take that profit and move on. On the flip side, if you expect the stock to go in your favor but starts to go against you, so if you sold that credit spread right near that level and the stock just continues to move lower, instead of bouncing higher above that level, what you want to do is you want to start cutting losses. Now, as far as when you decide to cut losses, that depends on how much credits that you receive. So if you follow the methodology that we're showing you, where the credit that you receive is 1/3 of the width, then you want to cut your losses at about 75 to 100% loss of the income that you receive. Now, if you don't follow our rules and you insist on selling relatively far out of the money credit spreads with very high probability of profit, then what you're going to receive is credit that's less than 1/5 of the vertical width. So in that case, then you want to cut losses at 100 or 200% loss of the income that you receive. So you need to give yourself a higher buffer because you're collecting a relatively small dollar amount. You need a bigger buffer before you consider cutting your losses. So with this strategy, it does become a little bit more involved because unlike a debit spread, it's very simple. Once you've lost 50%, you cut your losses. Once you get 75 to 100%, you start taking profits regardless of what strikes you use. When you're selling credit spreads, it depends on how far out you sell. So different rules apply. So it's a bit more advanced strategy. It's a bit more involved when you're managing these trades. Plus, when you're selling a credit spread, you are at a higher risk of having one leg assigned to you. So you might find yourself either long the stock or short the stock with another option leg, and you have to figure out how to manage it. And usually when that happens, it's best just to close out the position altogether. Keep in mind that when you do have an early assignment on credit spreads, it does not change the risk profile of the overall trade. It certainly changes the trade for you, but it doesn't change the overall risk of the trade. So keep that in mind, that when you sell a credit spread, you put yourself at a higher risk of assignment. So with that, what I want to do is I want to jump over to options play. I want to show you guys some setups of some stocks and show you how to apply this type of strategy. So what I did is I first looked at the overall market today because we've had some pretty volatile days. We've had some pretty choppy days. But for the most part, XIU, the overall market, the S&P TSX 60 index has predominantly held this 2415 support level here. So I certainly think that from a statistical perspective, many times after these huge sell-offs, we typically get a bounce. Today was kind of a flat day, but if things stay relatively quiet, I do expect maybe more of a bounce. Again, statistically, markets move higher 55% of the time versus 45% of the time they move lower. So what I was looking for is maybe some more bullish opportunities as an example. So I was looking at a stock like Canadian Pacific Railway, relatively strong stock compared to the overall market, still making relative highs as the markets were kind of moving sideways and near some major support levels. This is still continuing to make higher and higher highs and higher lows. And it was just trading around that 310 support level or so. So again, when the stock is approaching its support level, those are potential opportunities to potentially sell a put credit spread. So here's a stock that recently pulled back from, based on the sell-off from about 320 or so back to 310. And basically what we're saying is that if I expect this stock to sit around the support level and maybe bounce a little higher, or maybe just stay within this kind of range around 315 or so, which is predominantly where it's been trading over the last few weeks, that is typically what you would consider as a condition to sell a put credit spread. So let's take a look at that. I'm going to play a bit of a contrarian here and say I'm bullish on this particular stock because it's relatively strong, even though trends are starting to deteriorate. I'm basically playing for a quick bounce here. So if I bought a call option or a debit spread, those are the two other strategies that I'll take a look at and help you compare them through. But what I'm going to do is I'm going to modify my strategy, and I'm going to change my bullish stock trade to a short put vertical. And what I'm going to do is I'm going to change this to a September expiration because I want to sell about 4 weeks out, just like what I was showing you here before. And what I'll do is I'll sell maybe the 310, 305 put spread here as an example. So this is a $5 wide credit spread. I'm collecting about $1.60, which is just about a third of the way. So as I was saying here before, let's clear this. As I was saying here before, when I'm selling something for a $5 width, I'm looking to collect roughly $1.67. So here what I'm doing is I'm collecting roughly $1.60. So right in the realm of what I'm looking for. So what I want to do is, in order to compare the credit spread to the call or the debit spread, I'm going to first normalize this by showing you this across the same risk profile. So let's say I'm willing to risk $2,000 on this trade. I can sell 5 contracts for the put credit spread. I can buy 1 contract of the call or 2 contracts of the debit spread. So what I want to do is I want to compare apples to apples here. So Canadian Railway is trading around 312 right now. I was saying that, modestly, I think the stock could really bounce to maybe about 316 or so. So if the stock bounces up to 316, whoops, that's 216. If the stock bounces up to 316, as you can see, for my $1,700 that I've risked, I'm going to make an $800 profit on this stock bouncing from that 300 to 315 level or so, right around there. So as you can see here, if I had sold the credit spread, I make an $800 profit. If I bought the call option, I'd lose 46%. So buying a call option, even if you call the direction correct, does not guarantee you any profits, because not only do you have to call the direction correct, you also have to call it by a certain amount of magnitude. And as you can clearly see, if the stock rises $4 or so, you're actually going to lose money on that call option. And that part is a little frustrating for some users when they first buy their first calls and puts, is that they call the direction correct, the stock goes in the direction they expect it to, but they still lose money. The same thing on the debit spread, which is designed to minimize that a little bit. As you can see here, instead of losing $560, I'm losing $520 on the call spread. So both result in a fairly substantial loss, even if I call the direction correct. And even worse, if the stock stays where it is, if the stock doesn't move and it just stays around that 310, 312 level, as you can see, the call and the call spread lose even more money versus the credit spread makes me $800. And even if the stock moves a little bit below, let's say it moves down to 309, 308, I still actually continue to have a small loss on the credit spread versus the other ones where I'm basically losing everything. So this is why this strategy here on the right, the credit spread, is what we call a very forgiving, high probability strategy, because in most cases it will make money. Only in a big move to the downside does it risk the same amount of money as the other two trades. However, the trade-off here is the fact that if the stock was to rally, so let's say the stock does make a pretty big bounce back up to that 325 level or so, it's just trading at 325, less than last week. So at 322 last week, and it was up at 322 about a month ago. So what happens if it goes back up to 322? As you can see here, actually both the credit spread still makes the most money, $800 versus only a $40 profit on the call and a $680 profit on the debit spread. So as you can see here, the call is just basically break even at that point. So you really have to have a big move to the upside for it to be worth buying that call option. Versus that debit spread looks a little better, but still you're risking $1,700 to make $680 versus risking $1,700 to make $800. So you can really see that this stock really needs to make a big move to the upside. This stock needs to move back up to its 52-week high, which is around 324, 325, before these strategies start to make, if it moves up to 325, as you can see, that's when this strategy here on the right, the debit spread, starts to outperform. So if you are fairly bullish on the stock and you think it's going to make a big move to the upside and break above that new 52-week high, that's when you do want to consider selling or buying that debit spread. Otherwise, in pretty much all other scenarios below that level, you're better off selling that credit spread. So this is really where you can help utilize this tool to help you decide, how far does the stock need to move before the debit spread makes sense? And if I don't think the stock's going to move that much, I might be better off selling that credit spread. And this tool is really designed to help you put any two strategies side by side and really see how far does the stock need to move before the debit spread starts to make more sense. Because the other aspect to remember here is that if the stock does rally significantly, let's say it rallies up to 330, as you can see, for the same $1,700 profit that $1,700 that I've risked, here I can make $2,200 back from that $1,700 that I risked. Versus here, no matter what happens, even if the stock goes up to 500, I'm still only going to make $800 profit. So you don't necessarily want to risk $1,700 just to make $800 if you think the stock's really going to rally. Because if you think the stock's going to really rally, there are other strategies that allow you to risk the same amount to make substantially more. Because if this stock rallies up to its one standard deviation move around 337, here you can make $1,500 or $2,200 on this specific stock. And that's really some of the benefits that you get from buying a call or a put. Next, I just want to do one more example because, again, I think the best way to learn is by example. I'm going to use a marijuana stock since a lot of you like to trade this. I was looking at Hexo because marijuana has taken a huge, huge move to the downside since May on a lot of different reasons. But recently, it kind of formed this kind of double bottom here around $5 or so. And again, this is just for educational purposes. This is not a solicitation to trade any specific securities. But my thought was, what if this was forming a bit of a double bottom here? We're going to get a little bounce, even if it just gets a little bounce to about $6.50, maybe not even to $7, but at least we get kind of this support level here, down here about $5 or so, and it's going to get a nice little bounce here to the upside. How do I play that? So I was looking at this and I was going to say, I'm going to be a bit of a contrarian here. I'm going to select I'm bullish, so I can buy a call option or I can buy this call spread, which actually looks pretty nice. But let me take a look at selling a put credit spread. So I have a few different spreads that I can sell. I can sell the $5 put and buy back a $4 put for roughly 20 cents, which would mean that I'm risking $80 to make 20 cents. Not a great risk reward ratio. Or I can sell the $6 put and buy a $5 put against that. It's a slightly different trade, but maybe let's take a look at these as possible examples. So again, in order to compare apples and apples, let's say I'm willing to risk $1,000 on this trade. I can use our P&L simulator to do that. And I can sell 28 contracts with this put credit spread. I can buy 10 calls, or I can buy 14 debit spreads. Let's compare this side by side. All of these strategies are risking roughly $1,000. So let's see, if this stock stays just where it is around $5.34, here I basically break even on my credit spread. But as you can see, if I bought the call, I lose $610, not a great result. If I bought the call spread, I lose $504, also not a great result. But that's to be expected, because if I buy a call or a call spread and the stock doesn't move, I know I'm going to lose money. Versus on the credit spread, I basically break even here. So what happens if the stock does make that small bounce to about $6 that I was saying here? So if the stock bounces up to $6, here I make $1,800 profit. Versus on the calls, I make a $50 profit. I'm basically breaking even on these calls. And the debit spread, I make a $420 profit on a $1,000 risk. Not a great result. So as you can see clearly, if I sold that credit spread, I make that $1,800 while risking $980. Now again, that's not normal, because again, I'm selling a credit spread that's already in the money. And that's only because there isn't a 550 strike on this stock. It's a relatively low price stock, so the strikes are relatively far apart. If you sold that out of the money credit spread, I'd still make a $560 profit on the $2,000 that I'm risking. So first of all, I probably change that risk again. But here's the example, and the thing that I'm trying to teach you here is that you can set up any strategies that you want: a credit spread, a call spread, and put the three side by side and see, well, how far does the stock need to move? If it moves back up to that 650 level, which is, I think, is a reasonable level for it to reach. As you can see here, if I sold the credit spread, I make $1,800 versus the call, a $550 profit, versus a debit spread, $1,100 profit for it. So still, I would still sell that credit spread. Only if I get a big move to the upside, I think maybe to $7. So at $7, these two are going to be identical again. Relatively similar strikes, but at 17, if the stock rallies up to $7, which is a pretty big move from a percentage perspective, then you get, the debit spread starts to make more sense. But this tool is designed to help you put the power in your hands and not just follow, someone else blindly, not just buy call options because it's bullish. Put the actual strategies side by side. Put in your own outlooks as to where you think the stock will go, and the tool will help guide you as to what is the right strategy for your setup. And this is true for those of you, many of you raise your hand and said, I don't know, I'm just learning options, right? So if you're just learning options and you're just learning about call options, forget everything I just said. You can modify this and change it to 3 different call options. So instead of buying a September call, an October call, and maybe a November call or a January call and compare it, or maybe different strike prices. So maybe you're trying to compare an October $5 call to an October $6 call. You can put these two strategies side by side based on your outlook as to where you think the stock will go. It will show you which strategy gives you the higher return on your money, and you'll be able to instantly see what strategies you should trade. So again, let me first normalize this. That'll help you better understand these strategies. So as you can see, you can either buy 40 contracts of the September $6 calls, 10 contracts of the October 5 calls, or 11 contracts of the January $6 calls. And if you think the stock's going to rise to a certain amount by a certain date, this tool will show you how much profit you can expect from each one of these three strategies, and that's going to help you guide you as to which one is best suited for you. Don't just follow what someone else tells you how to do or what someone else says is best. Put your own inputs in, and this tool will allow you to be self-sufficient in analyzing option strategies and exploring them and ultimately executing them at your broker. And once you're ready for trading, all you have to do is hit the trade button, and we'll show you how to enter these trades into your broker's platform. And again, for those of you that trade at brokers that allow for multi-leg execution, you should be able to plug these numbers in and send them off. If not, I highly recommend you to take a look at some of the brokers that some of the other attendees on this webinar have suggested, either at Interactive Brokers, Questrade, BMO Investor Line, TD Warehouse, Desjardins, and Fidelity are offering multi-leg options trading. So with that, I just want to thank everyone for taking the time out here this afternoon. I really hope that this was useful in helping you guys better understand the credit spread strategy, but also more importantly, showing you the power of options play and how it can help you inform your options trading decisions and become self-sufficient in doing your own analysis and not just, again, follow what other people are telling you, but actually construct strategies that are suitable for your own outlook on each individual stock. And not just buy a call because you know that's a bullish option, but buy a call because you know that that's the best strategy for you. So with that, I want to thank everyone for taking the time out here this afternoon. This webinar is recorded and you will get the slides afterwards. We will send that out to everyone in an email about 45 minutes after we finish here today. So if you have any questions regarding anything we just discussed here today, please type them into the chat window, and I'll answer as many questions as I have time for here today. Thank you so much for everyone that participated in telling me what broker you trade with and what strategies you currently trade. I really hope that this was useful in helping you expand your horizon, since most of you said that you've never traded a credit spread here before. So Matthew, thank you so much. Shouldn't expiration date be the same when comparing different strategies? So Matthew, that might be the case, but best practices for selling credit spreads is shorter dated options. Best practices for selling longer dated options best practices for buying options such as calls and debit spreads are for longer dated options. So that's why we were comparing them on separate expiration dates. You can certainly compare them across the same expiration date, but best practices for those two strategies are different, which is why we set up different expiration dates. So this is a common question, and I saw a couple of these questions here today, and I want to address this. Someone's asking, it looks like the bearish credit spread requires an uncovered call. This is not allowed by my firm. Am I reading this correctly? So by definition, a vertical spread is not uncovered. An uncovered spread means you're just selling the call, but you're not just selling the call. You're also buying back the call. That's the whole point of the credit spread, is so that if you just sold the call, if you just sold this call option, yes, you would be considered naked and exposed. But what we're doing is we're also buying that call against it, so you're not uncovered. That's the whole point of selling a credit spread, is so that you're not uncovered. So yes, I understand many of you cannot sell a naked call, but that's not what we're suggesting that you do. We're telling you to sell the spread as a single strategy. So that means that this call is no longer uncovered. Great question. I hope that helped clear some of that up for some of you that are here today. Let's see. Tony, I have to leave the session early. However, I wish to thank you for all the valuable information. You're the man. Thank you so much. Um, so again, for those of you that are in Toronto, I will be in Toronto on September 14th for the Options Education Day. We will be sending out more information to everyone this coming week. So for those of you that are in Toronto or in that area, I'd love to see you guys out at the Options Education Day. We have a great day of events from a lot of speakers, and there's different tracks. We have a beginner track and an advanced track. So for those of you, regardless of where you are in your options education journey, come and we'll be able to show you some more resources and show you how the different resources that are available to everyone here in Canada to help you learn more about options trading. Azim, very good, clear, nice details, much better. And can you talk about selling puts going against you during the period? What do you do to reduce risk or assignment? So the reason that we like to trade these vertical spreads in general, again, is because they have limited risk and reward. Now, because these are limited risk and reward, you already know what your potential worst case and best case scenario is. That's why, for the most part, there's not much that you need to do to really manage these trades. You just have to figure out at what point do you want to take profit, at what point do you want to cut your losses. So again, these are the typical rules that you want to take profits and cut losses. If you follow these rules for the most part, you will minimize your risk of assignment, but that's always a possibility. Again, when you're selling these types of options, especially near the money options, you have a higher probability of being assigned early. Just keep in mind that when you are assigned early, it doesn't change the risk of the actual trade. You just simply want to exit the trade as a total strategy. Because you generally will only get assigned if the trade is going against you. So at that point, you just want to cut your losses and move on. There isn't much that you need to do beyond that. Abraham is asking, how much is the software subscription for US and Canada market? So just to explain again, for those of you that are in Canada, you get access to Options Play completely free of charge, courtesy of the TMX for Canadian securities. This is, again, available to everyone free of charge. The tool that I just showed you for Canadian securities. If you're interested in trading US securities, we do have Options Play for the US, which you can sign up at www.optionsplay.com, which I will also send a link in the chat window right now. So you can either sign up for the free TMX version, or you can get the US version, which has a free 30-day trial plus a subscription cost once you are past the 30-day trial. Daniel's asking, hi, Tony, how does the trading strategy change if you're long the underlying stock? For example, if I've been using a strangle on a long position at support or resistance, I'm okay with assignment on either end. Should I use credit spread instead? So no, if you're long the stock and you're comfortable with either buying more stock if it falls, and you're okay with selling your stock off if it rises, then no, you should stick with selling your strangles. Because that's, again, more so for the stock to stay in a relative range, and you're okay at either end of that range to either buy more stock or sell your stock at a profit. So I would suggest that you stick with the strangles for that. Do you have a service of credit spread signal in the Canadian market? So no, we only have one for the US market. Andre, may I get the slides, please? Yes, we will send out the slides as well. Raj, first time here, you were very clear and precise and explained it well. Thank you so much, Raj. I really appreciate it. If you want to learn more, if this is your first time, please take a look at our options video library. We have a lot more videos on a lot of different topics that you can learn more about. This is just one very specific option strategy. John, I will see you at the Options Education Day in Toronto. Great. Peter's asking, I was told that we should sell cash secured puts on stocks that we'd like to own in case the option gets assigned. Should we also sell put credit spreads on the stock we'd like to own, or does it not matter? So Peter, if you don't mind owning the stock, you should just sell the put, because when you sell the put, you collect $4, right? The only reason that we buy the $90 put and pay another $1 for it is because there are users that don't want to own that stock and they don't want to risk of owning that stock. So if you want to own the stock, take the full $4. Don't just settle for $3, because the income that you receive is the discount factor you get on the underlying stock. So if you don't mind owning the stock, keep the whole income. Don't buy the lower income and give up $1 of the income that you receive. Jeffrey, betting on the markets, SPYQQQ. I'm not sure what type of question that means, Jeffrey. If you don't mind elaborating, I'm happy to answer that question. Ro, can you tell MMX to, I'm guessing that's the Montreal Exchange, to post IV rank and percentile? Would be nice to know when volatility is high. Further, you can add delta to your optimized cover call and short puts list. So first of all, our cover call and short put lists are always the same deltas. We actually tell you what those deltas are in the spreadsheet themselves. So if you just look up in the disclaimer, we'll tell you what deltas they are. We always use the same delta for calls and puts. By the way, will you add portfolio functionality to the Canadian version? So that will not be in the Canadian version as of right now. That could be in the future. And by the way, Tony has done more advanced option trading and education in Canada than MMX or the big banks. Well done. Thank you so much. Abraham, I noticed that MMX, there's no liquidity, so it is not worthwhile to trade options in Canada. So that's, I think, is a pretty big misconception as far as there is no liquidity. The thing about liquidity is that it's not first of all, it's not an easy thing to measure, and just by looking at your screens is not a good giving you a sense for liquidity. What you want to look at is actually executions, which many retail traders may not have access to time and sales of options. But if you look at option executions, there is plenty of liquidity, especially in the multi-listed stuff. So even though you might not see a lot of volume, you may not see a lot of open interest, but liquidity is there. So don't be deceived by what you're seeing on the screens. Wallace is saying, hi, will you talk about strategy like collars in upcoming sessions? So I talk a lot about selling cover calls, and I talk a lot about selling cash secured puts. Collars, and I do also talk about hedging. So we talk about that more so in our hedging webinars, Wallace. So if you want to learn more about collars, take a look at the hedging webinars, because that's really the only reason that you want to trade a collar, is because you are expecting a downside move and you want to be able to purchase that put with a relatively cheap price by selling upside calls. So take a look at that on our hedging webinar. Riz is asking, what about rolling the trade to stop loss? So my philosophy on trading is the fact that, if the reason that I don't like to roll a trade like this is because the only reason that I enter a credit spread is because I believe the stock is going to reach that $100 level and it's going to bounce higher, right? So it's either going to bounce higher or it's not. So if the stock starts to plummet below it, then the support level that I expected to stay at is no longer valid. Why should I keep putting money on this trade? That is completely wrong. There's no reason for me to continue to throw money and risk more money on this specific trade. So that's why I don't believe in rolling a losing trade. I do believe in rolling a winning trade where you need maybe a little bit more time, or you want to add more leverage to the trade. But on a losing trade, just what sets successful traders apart from others is their ability to manage risk. So when a trade is going against you and you can accept the fact that you're wrong, take that loss and move on to the next trade. Maybe there's another support level to the downside. Maybe now it's reached that $90 support and you think it's going to bounce off that $90 support level. That's a whole different trade. But accept the fact that the first trade is wrong, cut your losses, and trade another trade if you have another trade to make. But I don't believe in throwing good money after bad money just to try to get yourself back to break even. Tony, thanks for your response. You're very welcome. Jeffrey, like spreads on SPY and QQQ, 286 put, 286 call ETF trading. Again, I'm not sure if that's a question or a statement. You certainly can use these types of levels to sell credit spreads on. Again, if you feel that the markets are oversold, these are typically ideal candidates for selling a put credit spread, especially on SPY and Qs. Those are very suitable products for selling credit spreads. Riz is saying, aren't we buying theta as we roll the trade so that we can potentially bounce back sometime in the future? So again, Riz, my point is that yes, you can certainly do that, but close out the first losing trade. And if you need to open up a second trade because you think that it's going to bounce higher in the future, that's a totally separate trade. You should manage the risk of those trades separately, because if you don't manage them separately, you're just going to find yourself in a position where you're going to throw more and more money on a losing trade. Where maybe, what if it keeps going down and doesn't make that? Are you going to throw another, $1,000 at the trade and buy yourself more time? And very easily you're going to find yourself in a hole that you can't get yourself out of. And that's my point, is that if the trade doesn't work out, first close that trade, take a loss, and then decide, do you want to place another trade? Because you don't want to mix the second trade with the first trade just by trying to get yourself back to break even, because that's when you find yourself in a big hole. I'm just telling you from experience as a market strategist working with thousands of traders in the past, how people get themselves into holes. And it's always because, hey, I made a trade that didn't go right, but I think it's going to come back, so let me put some more money into it. Next thing you know, you've done that 3, 4, 5 times, and you are now risking 5 times what you originally intended on, and you've risked substantially more money than you should on that specific trade. So if you have a losing trade, let it go, and then ask yourself, would I make another trade if I didn't just have a losing trade? 9 out of 10 times, you're going to find the answer to that question is no, I would not place another trade if I wasn't already in a losing trade. So separate the trades from each other, learn how to take a loss, and move on to the next trade. Thanks for showing how to compare trade strategies. A tool, you're very welcome. Will you add labels to the technical indicators on the bottom panel of the stock? So a tool, we are looking at a brand new a charting package that's going to have a lot more functionality and customization that you can do on the page. So we are looking at that as opposed to adding to the existing functionality of our charting tools. Jeff is saying, I set up alerts with my set profit that go to my phone. That's great. A lot of traders like to do that. Abraham, I have entered many day orders on options recently in Montreal Exchange and did not get filled. If not, is it not the issue of liquidity? So I think it's more of a matter of where you place your limit orders. So if you place your limit orders very aggressively, if you're really concerned about liquidity and if you really want to get execute a market order. So liquidity is there. It's just a matter of where you place your orders. Kenny's asking, do you present options shown on the right ever show low volume open interest? So we don't look at open interest and volume because open interest and volume is really not a good indication for liquidity. What we look at is the size of the bid-ask spread. So if something's trading at 80 cents by 95 cents on a $5 stock, that's a relatively decent spread on that trade. So let's take a look at something a little bit more liquid, maybe like Bank of Montreal trading at $92. So instead of looking at open interest and volume, which really has no gauge of liquidity, we look at the size of the bid-ask spread, and we look at the spread and liquidity of that. So we analyze spread and liquidity we look at liquidity through the spread, not open interest and volume, because open interest and volume is really not a good gauge for liquidity at all. Kenny, is it easy on the options play US version? Yes, you can also cancel. You can always cancel at any time. You can subscribe to a monthly subscription if you don't want to commit to the year, and during that month you can cancel at any time. Abraham, yes, I always did mid price. So yeah, mid price is basically saying give me the best possible price. So yeah, it's not a surprise that you didn't get filled. Because the mid price, basically a market maker makes no money on that trade. And you're basically asking them to fill you without them making any money. So usually on a trade like this, let's say when something's trading at 305 by 320, right? I would place that order at about 315. A little bit above that mid price if I'm trying to buy, and a little bit below if I'm trying to sell. I would usually start about 5 cents above the midpoint as a starting point if I'm buying, or 5 cents below the midpoint if I'm selling. Roe, very good point. Rose says, in my humble opinion, defending a trade requires further risk, time, and opportunity cost. Close it, move on. Not every trade will be a winner. Manage losses. So that's my sentiment exactly. I'm glad that Ro, you have that mentality. I will say that I think that's in the minority. I don't believe most attendees see that. So again, I will repost what Ro said about close. Understand that not every trade is going to be a winner. Know when it's time to cut your losses and move on, because that's going to be the most important thing you can do as a trader, is to manage your losses so that you have enough capital to trade another day. Don't try to trade every single loss into a winner, because if you're going to do that, you're just going to end up risking more money. You're going to waste a lot of your own energy trying to come back from a losing trade. And that is not a good mentality to be in, to think that you have to win every single trade. If you put yourself in that position, chances are you're going to find yourself in big holes that you didn't intend to be on to begin with. Any other questions? Spent a lot of time on questions here today. Great questions, everyone. If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. I'm really loving doing these webinars here. In Canada, we're finding a growing audience here. I'm really glad that each of you come here every other week to learn more about options trading. We're going to continue doing this for you guys to make sure that you guys have the tools that you need to learn how to trade and have the tools to analyze your own trades and be self-sufficient in your trading. I really hope that this was useful to you, and I'm really happy and looking forward to seeing many of you in Toronto in a couple of weeks. I saw many of you in Montreal, and looking forward to seeing many of you in Vancouver and Calgary in November. So I hope you guys have a great afternoon, and I will see you guys in a couple of weeks. Have a good evening.